Hey everyone, welcome back to Dollars with Diz. In this video, we're going to go over the difference between a fixed rate mortgage and an adjustable rate mortgage. A fixed rate mortgage is a home loan where the interest rate stays the same for the entire loan. This means your monthly payment for the loan won't change. An adjustable rate mortgage, or ARM loan, as people call it, is a home loan where the interest rate can change over time. This means your monthly payment could get higher or lower in the future. So as the highlights kind of show you, the big difference between them is if the interest rate is changing or not. This table lays out a couple other differences between a fixed rate mortgage and an adjustable rate mortgage. The initial loan length for a fixed rate mortgage is either 15 or 30 years, whereas for an adjustable rate mortgage, it's typically 3, 5, 7, or 10 years. There is never an adjustment of that interest rate on a fixed rate mortgage. Again, it is a fixed rate for the whole life of the loan, but on an adjustable rate mortgage, it can either be adjusted every year after the initial term or every 6 months. Because of these time differences, the initial interest rate on a fixed rate mortgage is typically higher than it is on an adjustable rate mortgage. The table below here kind of just shows you how you can read the term lengths and adjustment years on adjustable rate mortgages. So on the first one here, you have 3-year fixed for the initial term, and then after the slash, it adjusts every 1 year. The second one is a 7-year fixed, and then again, slash adjusts every 1 year after that. And the next two, you have 7 years and 10, and both of these adjust every 6 months after that initial term. So in this slide and the next slide, we're just going to go over how much more or less you're going to be paying based on if you use a fixed rate mortgage or an adjustable rate mortgage. So on the left here, we have our fixed rate mortgage at $109,900. It's a 30-year loan at a fixed rate of 5%. On the right, we have our adjustable rate mortgage, the same loan amount. It, for the whole life of the loan, will be 30 years, but it's adjustable. So it's only fixed for the first 5, and then it adjusts every 6 months after that. And the starting rate of interest, again, because it is an adjustable rate, it is usually lower than the fixed. So the starting rate is 4% instead of the 5% you're seeing on the fixed. So in this example, you're going to see what it's like if the adjustable rate mortgage actually increases versus our fixed rate mortgage. So in these tables below, and the table on the left, you can see the year, our number of payments based on our 360 payments of 30 years, our rate, our balanced principal amount, and then how much interest we're actually going to pay based on our fixed rate and the loan balance shown there. On the right, same thing, but as you can see in the interest column, our interest rate is increasing based on the adjustable nature of the mortgage. So when you add all of this together, you can see our total interest paid, and again, this is just pulling out a few specific payment dates. But on the fixed rate mortgage, our total interest paid on these payments is $2,005.98. On the right, for our adjustable rate mortgage, you can see in the first 2 periods of payments, so our year 1 and year 5 amount, we're paying less than our fixed rate mortgage because we're at that 4% locked in for 5 years. But after that, because it's going up, our total of interest actually paid over the course of these payments is $2,265.61. So you're basically paying about $260 more on this scenario with the adjustable rate mortgage because the rate is going up versus the fixed rate mortgage, which the rate stays the same for all payments. So in this slide, we're going to do the opposite of what we did in the previous slide. Instead of the adjustable rate mortgage interest rate increasing as the life of the loan continues on, we're going to see what it looks like if it does decrease. So again, fixed rate mortgage on the left, 30 years, 5%. Adjustable rate mortgage on the right, it's fixed for 5 years and then adjusts every 6 months after that. The interest rate on the fixed rate mortgage is going to start at 5, and the interest rate on the adjustable rate mortgage is going to start at 4. The chart on the left for the fixed rate mortgage is identical to the one above because nothing is changing. It's a fixed rate. Every month and every year, you're paying the same interest rate. So the total here of $2,005.98 is the same as the previous slide. But when we look at the adjustable rate mortgage, we start out at our 4% for the first 5 years, and then we realize in year 7, it actually adjusts downward to 3.5%, and goes down again to 3.25%, and then to 3%. So when we multiply those together, our total interest, again, on the fixed side being the same as it was in the previous slide, But on the adjustable rate side, it is no longer more than the fixed rate mortgage. It is about $600 less, because as the term of the loan continues, we realize that the interest rate is falling instead of increasing. So now that we got through the math differences between a fixed rate and adjustable rate mortgage, this slide just lays out the pros and cons. And you'll notice that they're pretty similar to what we talked about before, and kind of follow the actual definition of what they are. On the fixed rate side, the biggest pro is that your monthly amount will never change. So there'll never be a surprise in having to pay more over the life of the loan. And that allows you to easily budget for future expenses and planning in general. The cons is that you start out with a higher interest rate, which again will make you initially pay a little more than it would on an adjustable rate mortgage. And it's harder to get a lower rate if rates drop. So if you realize that interest rates are decreasing, you are unable to get the benefit of that decrease because you're locked into that fixed rate. And so because of that, if rates stay low or get lower than what you're paying, you could be paying a little bit more than you would have if you were an adjustable rate mortgage. The pros on the adjustable rate mortgage side is that the first one being your initial interest rate is a little bit lower than it would be on a fixed rate mortgage. The second one being is that you do have a chance to save money if rates go down. And then on a short-term planning scale, say you don't want to live there as long as you expect, you can take advantage of that starting lower rate and then refinance or sell the property after that. The cons are that payments may go up after the first few years when that rate adjusts. Your interest rate could increase, which would make it a lot harder to actually budget your future payments and economic situation, because you don't know what's going to happen. And then if interest rates do go up, your payment could be again a lot higher. So it's hard to figure out and plan for that situation. So the last thing on this slide is you'll notice that there's a lot of ifs here. So it's if this happens, this is a con and a pro. So it's a little bit difficult to fully realize what's the best situation, and it will depend completely on your own situation, because these ifs here, it's we can't predict the future. If we could, then we would pick one or the other. But these are in general, the pros and cons of each, and should be what you're looking at when you're trying to decide what mortgage to follow. That's it for this video. Thank you for watching. And as always, if you have any questions or feedback, please leave them below in the comments, and I'll talk to you next time.